How to calculate cash flow. Stay tuned for this episode of Prime Properties TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you could join me here today. Every week on Prime Properties TV, we take a closer look at the Toronto real estate topics and updates that matter the most to you. And in this episode, I'm going to show you how to calculate cash flow. Basic Real Estate Investing 101. Here we go. So if you like content like this, make sure you smash the like button and subscribe to the Prime Properties channel for more awesome real estate content like this. The button should be right here on your screen. Click that button. Thanks. Now, calculating cash flow is a very basic type of skill that you must have and understand as a real estate investor, especially when you get started. So I'm going to guide you through an example of how we do that with one of my clients' properties that we just recently bought. So shout out to Milton for letting me use his property as an example to provide all of you this information. So if you're looking to get the calculator that I'll be using in this video, you can get it using the link on the screen right here, or I'll put a link in the description below. You just have to put your email and I'll send it to you, free of charge. So without any further ado, let me share my screen with you and run through this exact example. Okay, so what you see in front of me right now is on the left-hand screen, the calculator that I'll put a link in the description below. On the right-hand side, I'm just using House Sigma to show you the data and some of the photos, right? So let's just kind of quickly go over the photos right now. It's a legal 2-unit in the East End in Oshawa. We put a little bit of work into it. We put a bit of pot lights here on about a day. Did a bit of repainting, and we put in some newer appliances and put a dishwasher in the lower level. You'll see that this is a back split. Actually, okay, you can't see from the photos, but it's a 4-level black split, so it provided a lot of value, and it had side-by-side parking. This photo here is the entrance to the backyard from the basement. There's exterior storage on both sides. We got this in December. Like, the pricing is obviously not what you're going to see it right now, but I'm just running through that example for you right now. We also installed pot lights here, and we redid the kitchen, which should be in the next photo. Yeah, so we replaced some stainless steel appliances, replaced the hardware handle, just to make it a little bit more modern, right? And we can command a little bit more rent. But as existing, I think they were getting $2,050 upstairs plus and utilities included, plus 15 downstairs utilities included, right? So again, we got this at vacant possession. We closed in February, and now it's fully tenanted with new tenants at $2,300 plus utilities and rent, and $1,700 plus utilities. And you can see here there's double drive garage, right? So very nice part in the eastern part of Oshawa. So I'm going to run through the numbers with you and kind of go through line item by line item what it means. So we got this for $745, right? So that's the purchase price. Now with the down payment, you need 20% down. Now I know some of my clients are using their first-time home buyers are calling it a personal home, so they don't have to use 20%. But I generally use 20% because, one, it allows you to amortize it for 30 years because it reduces the amount of payments you have to do, right? Because your loan goes further. So if you were to put 25 years in here, you can see that the mortgage payment becomes $2,500 instead of $2,200. So that affects your cash flow. Now with the interest rate, it's 2%. Realistically, it's lower, but I'm conservative with my calculation, so I always just put 2. Now the taxes here, the amount is $339. It's about $4,000 in taxes, and when you divide it by 12, that's how much you're gonna get. Now, obviously, most cities don't actually kind of charge you every month. It's usually every quarter, so you just have to pay a lump sum. But for the purposes of this, I'm going to use it as a monthly expense. Then you have condo fees. Obviously, this is a legal 2-unit, and there's no condo fees. It's a house, freehold, right? So no condo fees. Then there's insurance. Now with insurance, you can get a bit lower or a little bit higher depending on where you get coverage. But for the investor kind of package we have with our insurance brokers, it's about $100 so that you can cover upstairs and downstairs, sewer backup, and all that stuff. So it's about $100. Hydro, this one we split it up. Now with most of our legal 2 units, if the hydro has been separately metered, we generally get the tenants to pay for it and transfer the accounts. Now with what we've done this one, because this was only 1 meter for hydro, we just asked the tenant upstairs to pay for it, take over the bill, and then we do 60 upstairs and 40 downstairs, and the upstairs tenant pays for it, and then downstairs pays the upstairs tenant their 40%. And we just have some little tricks and little stuff in between to kind of get this sorted out with the tenants. And obviously, these are things that we help our clients with as well. Gas and water, it's very difficult to water in the Durham region, it's hard to get transferred into the tenant's name. So you would have to invoice them every month, and you just split it 60-40. There's systems in the back end you can do for that. But really, if it's just one property, just split it, text them something, and then get them to EMT you the money, right? And then the gas, you do 60-40. Again, we got the tenant upstairs to take over the bill, and same thing downstairs pays the upstairs 40%. So that means our hydro, gas, water is at a zero. There is a hot water tank. I think that it's either 28 or 35 bucks. Let's just put 35 bucks for the sake of it, right? And then that gives you your total monthly operating costs. Now, a lot of people would like to put in different line items for kind of like maintenance and vacancies, right? So if you like to put maintenance, let's just say it's about 1%, let's just say 2% of your total gross rent each month, right? So that's about $80. You want to keep that. If you want to increase it, if you want, you could decrease it if you want. I know some people want to use 4%, so I just put 4%. And then you can put vacancy. Now, we basically only in this property had, I think, 2 weeks vacancy because we had to do a little renovation when we closed in early February, and then it wasn't available to show until about like end of February. But the leases kicked in on March 1st. Oh, here it is. Yeah. So I put on MLS for the ones when it was ready on February 20th. And we had tenants for upstairs and downstairs filled. So we had 10 days of vacancy, right? Now that's obviously less than 1%, but a lot of people like to use 4%, right? But obviously we've never had to do that because we're very confident in filling for our tenants because this is something that we take care of our tenants for and we know the market. So that's why we're able to even push the rents on this, right? So then you're at another 160. So all in, after we filled it, 2,300 upstairs and 1,700 downstairs, you have 4,000 gross rent. So your total cash flow is your total rent here, subtract all these expenses that have been added up. So that's how you get every single month. My client gets $1,000, $1,005 in cash flow before taxes, which is crazy. Like if you think about it, this is crazy. It's a lot of money, right, for owning this property. Now the total investment cost was about $149 for the down payment. You got $11,000 for land transfer. Legal is about $15. They put in renovations. I was telling you about $5,000, so you're at $166,000 for total investment. So when you kind of add in cash flow alone, it's a lot of money. But when you blend in this, say, the mortgage pay down and also appreciation, there's a lot of stuff going on here. Now, obviously, you can't buy this property right now for $745. The market's like boom, blowing up, right? Like we were able to push the rents by like $500 with kind of like the little things we did, little tricks here and there. But if you were to buy a property of this caliber, I think if I were to put it on the market, we could probably get about $850 for it. So if you were to buy a property like this that's legal, relatively turnkey in a good pocket of town where a lot of people want the property, then you're looking at $850. Now, even at $850, your cash flow about $695. So this is why we like to look at legal 2 units, because the thesis in investing after you realize what cash flow is good for is that you want a good property in a good area so you attract good tenants. Because good tenants allow you to have lower management and headache issues while you hold the property. Because the longer you hold the property, the more money you're going to make, right? So this is why a lot of first-time investors, they chase too much cash flow and maybe they're going into like B areas or C areas where cash flow is higher. But there is something called like return on pain in the butt, right? Because sometimes the tenants you want are harder to find, right? Or maybe even the fact that like they're more difficult to manage, right? So when you have a good property in a good area, it commands high rents and it also gets you the better tenants that are easier to manage. So following that thesis is how I've always recommend to a lot of my clients who are kind of like first-time investors, especially young professionals who have equity in their house or they have some money from their jobs and they're just too busy with kind of like their work and like starting a young family that they don't want to have to manage construction or even kind of like what do you call it? Like losing my words here. So that you have to manage the property and put too much time into it because the tenants are a lot of issue, right? So this is kind of the thesis I have in how to invest in real estate. You want that cash flow because if, say, the world falls apart in 2 months, right? And you don't have money to pay for this property, you're still plus $700 a month that your tenants are paying for you in a good area, in a good house so that if the tenants do leave, you can fill it easier, right? This is what we saw in COVID, so that you're not going to be forced to sell the property, because cash flow is nice, but it's not going to make you like ball in rich. Cash flow is there to make you have stronger holding power on real estate, because you want to hold on to real estate for years and years to come to make money. So this is why you want cash flow. It's the insurance it's the insurance policy to prevent you from having to sell a property in a downturn in a market, so that you don't lose money. And once you ride out the ups and downs, your property appreciates. And what I always recommend to my clients is you want enough cash flow so that when you're ready to refinance, you can take that money out tax-free. And this is what I'm going to show you. If this property becomes $950,000, which very much it could be at this rate at the end of the year, and we refinanced it at, say, $950,000, watch this cash flow number. It's $695,000. But every $100,000 you tack on mortgage to your house, and this may be freaking some people up when it comes to the refinance, but this is how you make the real money. When you take $950,000 as a new mortgage, it reduces your cash flow to $400 a month, right? It's some money. You're losing about, I don't know what the math is, $300 a month in terms of cash flow. But the key is, and I'm just going to keep the math very simple. Mortgage brokers out there, you're going to grill me for this. This is not the right numbers, I know. But if you add another $100,000 of mortgage to it, you can take that $100,000 or 80% of it out in a debt form, tax-free. Now you can use this $80,000 to buy another property. You can use it to buy a new car. You can use it to fund your wedding. You can do whatever you want with it. And the key thing here is, because it is considered a new form of debt, there's no taxes. That's number one. Number two is, because you're still cash flow positive, your tenants are still paying for it. This property is still available for you to cash flow positive. So you don't have to sell it. So now you just made $80,000 tax-free coming out of it. And all the interest on the mortgage is still tax deductible, because it's your investment property, not your primary property, right? So this is an advanced tactic for any investors out there who understand how some of the tax systems work. This is why I say you should have cash flow, because it allows you to refinance and do things like this. Let's just say, another $100,000 go up. So we're at $1 million out in Oshawa. You still have $100 in cash flow left over to take another $100,000. And by that time happens, I'm pretty sure we can increase the rents to say maybe $2,500 and say like $1,850, right? So this is why you got to find the right property, know how to calculate cash flow, because cash flow is going to make you have holding power, prevents you from selling in a downturn of a market, and will give you a little bit of buffer so that, grocery money, gas money, whatever you want to call it, you can eat cash flow, but you can't eat equity and appreciation. But when the time comes, when you do refinance, you can take that money tax-free out. That's also when you want cash flow, because you don't want that property to go into the negative. And then obviously there's appreciation built in. So that's kind of how I calculate cash flow, teach my clients to hold properties, refinance, and rinse and repeat. Or if you want to refinance and buy a car, that works too, right? You do you. So hopefully this was helpful to give you an idea of how we kind of calculate the numbers and why we look at certain properties with higher cash flow than others. And this is why we have been telling a lot of our first-time investor clients to buy these houses instead of condos, because you want that buffer. Because if you were to go into a condo, it doesn't make sense, right? Let's just say you buy for $600,000, right? You have interest rate, taxes are probably $2,200 in downtown divided by 12. Condo fees on a new building, it's $350, and your insurance is probably $20. You're not getting more than say like $2,000 on that property right now. That doesn't make sense. Here you go, $2,000. So that means when you buy a condo in the resale market, right, you're minus $326 a month. So if the market goes sideways and you're paying $326 a month into the asset, you're like, why do I want to keep this? I'm going to sell this, right? When you sell at a downturn, it's when you lose money, right? So it doesn't give you as much holding power. So that's why cash flow is important. So hopefully this illustrates why we look at certain properties for certain people, and depending on where that person is in their portfolio, why the strategy differs, because everybody is at a different stage in investing and financially. Plus everybody has different goals. A lot of them are similar, but everybody is different financially where they are, right? So if you are looking for kind of more properties like this that do cash flow, I'll put a link to booking a strategy call with me on the screen here. You can book a call. It's www.chaozen.com. If you have any other questions or any comments below, you can leave it. Put them in the comments in the YouTube description, and also again, put this calculator that's on the left-hand side in the link so you can download it as well. All right, until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.